Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Welcome to the Smart Property Investment Show, the podcast by investors for investors. I'm Emilie Lauer, real estate journalist here at Momentum Media, the team that brings you the Smart Property Investment Show. And as we are fast approaching tax season, this was the best time to have an accounting expert on the show. This is why I am joined today by Munzurul Khan from KHI Partners. Munzurul, thank you so much for joining us today when you are so busy with tax season.
Thank you very much. Thank you for having me, Emily. Absolutely. Look forward to it.
So, look, tax season is starting in a couple of days. How busy are you?
Yeah, look, there's many investors who sort of organize this meeting at this point of time in terms of pre-planning, so to speak, right? There are a number of transactions, there are a number of matters which are time sensitive that you need to do it before 30th of June. So that's a pre-planning that we do. Now, saying this is that what we say to many of our seasoned investors, we sort of say that, well, tax planning is sort of do it throughout the whole year. It's just that there are some time-specific things that you must do it before 30th of June, but you stay in communication to your accountant throughout the entire year.
So what are some of the things that you actually need to do before 30th of June?
So there are time-sensitive matters, right? And the examples would be is that any deduction that you wish to claim. So let's say as an example that I'm a property investor and I've got a small repair that I need to do and the repair will cost about $900, argument's sake, yeah? Now, I've got a choice that I can do it now or I can do it in a couple of months later. Now, if I do it in a couple of months later, that sort of falls into the month of August. So it goes back to the next financial year that I can claim. I might actually bring forward that a bit and I might say that, well, let's spend that and invest that before 30th of June. And by investing and spending before 30th of June, I can claim it. So the investors are more on a concept called cash basis as opposed to accrual basis. Means what we pay is what we can claim, assuming that it's being correlated to your income generating activities. A similar example, Emily, is superannuation contribution. So superannuation contribution, whether it's an employer contribution, whether it's a concessional personal deductible contribution, anything which you physically pay and being received by your superannuation providers are the ones that we can claim it. So it gets time sensitive. So if we can pay it by, say, 20th of June, then yes, we can claim it on this year. But technically, you've got up until 28th of July next year to pay it. But if you pay it after 30th of June, not this year, next year is claimable.
Yeah, next year. So you gotta need to know when you want to get that money back in a way.
That's right. Absolutely.
So let's go and let's start with the beginning. How should investors prepare for tax season and what property expenses can they claim at tax deduction?
Yeah. And in terms of the property expenses, what they can claim, and then I suppose the first part of that question is that how do they prepare, right?
Yeah.
In terms of the property expenses, there are standard expenses that one can claim. Things such as like if you've got a rental property, interest is your biggest expense. Of course, you can claim the interest. You can claim council rate. You can claim water rate. You can claim repairs and maintenance. You can claim any level of cleaning. If it's a body corporate, you can claim body corporate fee. So all of those different expenses are claimable. These are standard. Then there are some expenses which are a little bit out of ordinary in the sense that we know those expenses, but they're not sort of as common. So things such as if you buy an investment property for the first time, you may have paid some council rates, solicitors fees and so forth, council rate, water rate, and so that you may have paid it as part of the settlement adjustment. So let's say as an example is that I bought a property in, say, December 2024. Now, the vendor, let's say on that example, actually paid the 12 months of council rate. Then what the solicitor does, solicitor says, okay, the council rate was about $2,000, but you actually bought it in December 2024. So the vendor should have only paid for $1,000, but they've actually paid $2,000. So the way it does is that on the settlement adjustment is that there is an adjustment being done where I, as a purchaser, I pay back $1,000 back to the vendor. Now, that $1,000 that I paid, very often we don't get to see them because they're all coming in one big lump sum amount saying a solicitor's adjustments. I've got a $783,500 to pay, but that includes this 1, 2, 3, 4 adjustments, which are all claimable. A similar example, Emily, is which I give very often is the LMI, lender's mortgage insurance, right? Very often is that lender's mortgage insurance gets capitalized, and when it gets capitalized as such is that it doesn't feel we paid it because I've taken a loan of a certain amount. And because I've taken a loan of a certain amount, I've got a 90% loan, but that includes a capitalized component of the lender's mortgage insurance. Now, that is also claimable over a period of 5 years or the term of the contract, whatever is lesser. So there are some obvious expenses that one can claim, and there are some not so obvious.
Yeah, definitely. And that's why for the not so obvious, you kind of need that expert next to you.
Yeah, and it's the experience here.
The experience. What are some of the other non so obvious expenses that you can claim as an investor?
Yeah. So as an investor, you always sort of look back and say that, well, what are the expenses that I genuinely incurred? A common example could be is that, let's say that I'm buying my second and third and fourth and fifth property either way, right? And I'm buying this particular property for 1 mil, and bank sort of says that, well, the way we will do is that we'll take 80% LVR, loan to valuation ratio, against that property. The other 20% of the deposit plus some of the incidental cost, which is your stamp duties and the solicitor's cost, generally speaking, all up about 25%, is that what we will do? That 25% we will draw that down from your principal place of residence. Your home, as an example, sitting at $2 million, you've only got about $600,000 mortgage, so you can sort of go all the way to 80% without paying any LMI. So what the mortgage broker does is to say, well, in the new investment property, we're only going to take 80%, and from your home, we're going to draw down the balance of the 25%, 20% deposit, 5% incidental. By doing it this way, you are all up below 80%, means that you're not paying the LMI. So that's fine. That's all okay, right? When you go to the year-end return, is that, of course, you can claim that 80%. But what I've seen sometime is that 20%, which is against your home, and the 5% gets missed away at times. And why does it get missed away? Because we sort of say, well, that's our home, and any interest against the home is non-deductible, which is true. But the underlying rule behind it is that what is the purpose of that loan and the interest? Now, even though by form, on that example, this is a principal place of residence non-deductibility, but in the underlying spirit of it is that I've drawn down that fund to buy that investment property, i.e. for an investment purpose. So on that example, the entire 80% plus the 25%, i.e. the entire 105% is tax deductible. So that's an example that unless you keep track of it, some of those interest, one, they get missed. Number two, they get very mixed up.
And 25 is a lot to claim back on it, yeah?
Yes, absolutely.
So how do you keep record of all of these little intricacies, and how should investors do it?
Yeah.
I'm guessing this is something you gotta do like over the year basis rather than like waiting for the last minute.
Yeah, no, 100%. How do you do that? Because the first fundamental is that it's all about that substantiation to do it in the right way. Australian tax system is a self-assessment system, right? Means that the commissioner sort of accept what you provide. However, the commissioner has got a right to come back and review it. And if the commissioner reviews it, audits it, then you need to substantiate. So how do you do it? Is that you, very often I see the investors are more Excel-based. And nowadays there's a whole bunch of different software being created as well that you can sort of record it. Either way is that you go on a month-by-month basis, all of your income and expenses. And in an ideal world is that all of your substantiation gets PDF'd and copied and scanned, and you've got a copy to it, right? You do that as a month in, month out as it sort of come along. On the year end is that you go back and re-review it and say, does it make sense? Does it seem like that I have completed everything? And if it does, that's a package that you send it to your accountant.
And way less struggle than having to go back through your email and find for everything on the last minute.
The risk of missing them out, right? Because then you're sort of finding out on the email. I mean, you may have found 9 out of 10 email. That one email that you sort of forgot or somehow being missed, that could be a $6,000-7,000 expense that you incurred that you were going to get $2-3 grand back. But purely because somehow we missed it, means that there is no benefit.
If you missed it, let's say, on that financial year, so this financial year, 2024, 2025, can I claim it next year?
The standard process is that you've got a mechanism where you can go back and amend the prior year. So theoretically, we should not be claiming next year because each year taxable income is different. Yeah, Australian tax system is a marginal rate, means that this year you could be, let's say, earning 120 grand. Next year you would be earning 210 grand. Means that if I don't claim it this year, I claim it next year, I'm still claiming the same amount, but I get more tax back purely because my marginal rate is higher. So what the commissioner says, go back and amend the return. Generally speaking, we can amend last 2 years. On exception basis, we can go up to 4 years.
Okay, very interesting. What are some of the biggest mistakes you see investors make during tax return?
Yeah, underclaiming and overclaiming, both. And
very interesting.
And the definition of the underclaiming and the overclaiming, that's an example of an underclaiming that I've given, that yes, a 25% which came in from my principal place of residence is generally is a tax deductible, right? That's an example that sometimes we miss that out. Overclaiming is that I sort of come in and say, well, I've got this particular property and I sort of spend about 8 grand on repairs and maintenance. I genuinely spend 8 grand. It generally is claimable. But the question is, how much of that is claimable in this financial year? How much do I depreciate and how much do I claim it upfront? Now, that sometimes is a whole bunch of rules around it, right? Is that what is the useful life? Is it 3 years or less? Is it much, much more? Now, if it is 3 years or less, generally speaking, you can depreciate 100%. You can claim that 100%. Am I replacing an asset? Or am I making do, i.e. that we're repairing an existing asset to bring it to its the original format as such? Now, if I'm bringing into the original format, it's a repair. And if I'm creating a completely brand new asset as such, then it would be a asset. So let's say as an example, I've got a carpet as an example, and I've just done a bit of cleaning and I've done a bit of patching on the carpet and I've sort of changed a portion of the carpet. Then that's a bit of a repair. I ripped up the whole carpet, brought it in a new carpet in. That's more of an asset. Overclaiming is that when we claim that asset inadvertently in our tax return, everything in the first year, when it really should be depreciated.
So what are the risks for investor when they do that?
Yeah. Under the self-assessment system is that everything is that what you do, the commissioner within reason sort of agree this. But the commissioner has got the right to review that every return. So as an investor is that you almost have to say that I will assume that all my returns would be audited at some point of time. What's the risk? If there is an audit and it was being found that unfortunately is that we've done something silly, the rule, as we call, is that one of the rule is that ignorance is not an excuse under the law, and means that, well, I didn't know this. That's sort of, it's good to hear. Not good to hear. I hear you, I relate to you, and I relate to you on a personal basis, but unfortunately, it's that under the law we'll ignore that, right? So on that basis, the commissioner has got the right to charge you interest and penalties, and the penalty is generally 13 to 15%, and the interest quite easily would be anywhere between 11, 13 or 15% as well. So when you pay 25% or more, and then it gets compounded because it could be 4 or 5 years earlier, is that it can become really, really, really painful, and then you become a high risk as a taxpayer from the commissioner, means that the risk is sort of reviewing this over and over again. So if you add away all of those things, one is that it's not the right thing to do, but number two is that not worthwhile of taking that risk in any shape or form.
Great. Next up is, how does the negative gearing affect investors' tax position?
Yeah.
Is there any limit to it?
Technically, no, but practically, yes. In the sense that, let's say as an example, is someone is earning about 150 odd grand and has got a whole bunch of properties, and I've got a negative gearing. Whatever that negative gearing, I can claim it against my taxable income. Now, if the negative gearing is over 150 odd grand, then it sort of goes into that limit of up to my taxable income, right? So that is the limit of my taxable income. But what is the negative gearing? The negative gearing effectively is your income minus your expenses from the investment property. How much was the rent? What were the interest, council water rates and body corporates and repairs and sort of renovation and depreciation and sort of cleaning? what is the net balance. Now, if the overall income, let's say 50 grand and expenses are say 75, then our negative gearing on that example is 25.
How does it work if an investor suddenly decides to move into that investment property, like let's say mid-year of financial? How do you calculate all of this afterwards?
Yeah, look, standard process is that you do a pro rata basis. Yeah, so I bought a property in July 2024, random example, right? And let's say as an example is that 1st of July that I purchased this property, I've decided to move into it on 31st of December. And I'm physically moving in. And the definition of physically moving in means that all of your utility bills being changed, your electoral address being changed, you're sort of actually physically moving in. So once I physically sort of move in, instead of end of December as an example, means is that first 6 months of deduction I can claim, and the next 6 months of deduction would be private in nature.
Okay. And so what are some of the other tax implications if you decide to sell?
Yeah, good one. Good question. Good question. I'm glad you asked because that's the second side, right? The second side means that, let's say if it were an investment property, a property which is an investment that's taxable within that period of time, and a property that you're not investing, you are living in there means not taxable. So on that simple example is that if we say July 2024, I bought it and I moved in there first, means that the first 12 months they were taxed because it was a straight rented, and then from December onward you would not be subject to capital gain tax. So when I sell this in about say a number of years later, is that I need to do a layer of pro rata to sort of understand how much of the capital gains attributed in the first 6 months as opposed to 4 or 5 or 6 years that I'm being owning. A second option is that if I do a valuation, I can rely on the valuation. Then the law gets a little bit more complicated. You've got this concept called 6-year provision, and you've also got a concept called, private against business use as such. So it gets a little bit more yucky, so to speak. But generally speaking, while you are living, no capital gain tax, and while you are investing, there is a capital gain tax. If you can prove it in a definite way, brilliant. Otherwise, always go with the pro rata.
Is there any way for investors to get some exemption over that capital gain tax?
Yeah, there's that when you live in there, then there is no capital gain. And let's say if you're living in there and you decide that I'm going to move out of it, and then I'm going to rent it out for a period of time. Not uncommon, right? Young couple very often is that they bought 1 or 2 properties and they may be living into their second property as an example. They say, well, you know what, we're going to go around into Europe for about 6 months. We'll do a bit of backpacking. We'll run around. We'll do this. They go to Europe. They say, oh, we love this. And we're going to stay in there. We're going to stay in Rome for next 2 years.
Oh, fantastic.
They end up staying in Rome for next 2 years, right? And they come back for 3 or 4 years later. Now, that's an example where the commissioner says is that even though, number one, is that you bought that property for you to live in there, you are living in there, you went for a bit of a overseas holiday, so to speak, extended holiday, that extended become a super extended, and you sort of came back within a period of 6 years. That's that 6 years provision. Assuming that you didn't have any other properties in Rome or somewhere else as your home, then while it is rented, you would still be receiving an exemption.
Very interesting. And I love that scenario. Munzurul, I kind of want to go and live in Rome for 2 years.
I was going to say Paris, then I was like, no,
I
go
love
with
it. No, Paris. Rome's so much better. And now I'm kind of curious in terms of, look, we know that a lot of investors know what they are investing as a couple. How does it work, with tax return if you co-own a property? How do you manage, how do you report those taxes?
Yeah, so if you own the property as a couple, you need to record them as individually on your individual pro rata basis. So you've got this 2 concept, right? One concept called joint tenancy or tenancy in common. Means that are we buying that as a 50-50 ownership, or are we buying it in some other ownership, 70-30, 80-20, 99-1. So if you're owning that as a 70-30, then you'll be recording 70% of the income and expenses on one spouse, and you'll be recording 30% of the income and expenses on the other spouse, right? Similarly, is that down the track is that when you're selling it, is that you'll also be paying 70% of the tax on the initial spouse and 30% on the other. So it all goes back to the original contract. how it was being purchased, and unless that contract gets changed, shareholding or the ownership gets transferred for some exceptional reason, generally speaking, whatever you bought initially that sort of is the way that it continues.
Which makes me ask, is there any advantages, taxes advantages to, for example, give more ownership to the woman rather than the man if and when she's going to go in maternity leave, for example?
Yeah, good question. Good question. It all depends on, I suppose, the one is that what's the income of the gentleman and the lady, and number two is that how long is she expected to be on maternity leave. And I suppose if I look forward to, say, 10 years or 15 years, what would be the projected income for her as opposed to him? She could be on maternity leave for a period of time, but income is so high, she may still be earning a lot more. Or it may be the other way around, right? But at the same time, also, Emily, it depends on what property we buy. So, say, example, you're buying a property which is sort of has quite a bit of negative gearing, then generally speaking is that you want to bring it in to the spouse who has got the higher income.
Okay.
So you get more negative gearing, right? But if you buy a property which has got more cash flow, it's got a granny flat which is giving a bit of a cash flow, then you sort of bring into the lower income earning spouse, right? Because the tax rate is lower, and even if it's positive cash flow, it doesn't pay much. But then at the same time, you also got to take into account of the exit plan. So it could be that, let's say, as an example, the gentleman is earning a bit more. So you sort of say, all right, I'm going to put that on the gentleman's name and I'm going to get a whole bunch of negative gearing, which is great. It sounds great, right? But if your exit plan is to say that, well, this property is going to go through a rezoning and, well, I bought it for 800,000 within the next 3 years, it's going to be about 2.2. Because of the rezoning that is going to go through, and I'm looking forward to sell that 2.2. Now, the fact that is at a very high marginal rate, even though you've got more negative gearing in the first 1 or 2 or 3 years, is that he's the one who has to pay the capital gain. And on that example, because the gain is so substantial, 2.2 against 800, means that you'd get a little bit of benefit in the first 1, 2 or 3 years, but you would pay a stack lot of tax at the end. So you almost got to bring in different conflicting layers of information, right? That whose income is higher, whose income is expected to be higher in the longer period of time. Is it a positive and negative cash flow? And what's the objective of this property? Do we hold on to that property for a very long period of time? What's that objective? When you add away all of those, you sort of almost sort of say that in the balance, that perhaps this is the right answer.
Very interesting. Is there any other advantages to maybe put it under a trust or a company instead?
Yeah, look, a lot of people go into a trust, and trust is not an uncommon structure. The benefit of the trust is that fundamentally couples. So one benefit is trust is that it sort of technically don't own anything. There's some exception, a concept called alternate ego, but we'll set that aside. But generally speaking, technically you don't own anything. You control everything. And if you control everything means that you've got that asset protection. So that's the reason why people go on trust. Second reason why people do go on trust is that if it's on a trust is that when you buy that property on that example, 800,000, going up to 2.2 is that now you've got a choice. You can distribute it to him, you can distribute it to her, you can distribute to lots of other beneficiaries within that definition of the trustee. So it's a lot more flexible from a tax-wise, and also it gives you the asset protection. Negative on a trust, though, potentially, is that sometimes one says that, well, there is a bit of setup cost, running cost, but one main negative is that land tax. In New South Wales, as an example, you pay land tax from $1, so there is no land tax threshold in New South Wales. Yeah, Queensland, you get a little bit of threshold, but very small layer of threshold. So land tax is a negative. Sometimes people sort of say, well, from a funding wise, is there a benefit on a trust? A concept called self-sustaining trust. There are potentially some commercial benefit with some of the bank, and with the other banks, there's potentially isn't. So generally speaking, I sort of say to the investors, why don't we buy a couple of properties first on individual name, then we go into the trust, because the couple of negative on the trust, land tax, and also you don't get a CGT exemption on the trust. Those sort of doesn't apply because I've already got few properties on individual name.
Very interesting. How can an investor legally minimize tax on, rental income and capital gain?
Yeah, okay. I think I think, Emily, the first thing is that keep all the substantiation. So what you are eligible to claim is to ensure that we're claiming all of those, right? Not to give away things that we can claim. So it's about almost that low-hanging fruit, not to let those go, low-hanging fruit. Let's get those low-hanging fruit. That's the first thing, right? And once you do that, where we sort of say that, okay, all deductible expenses that we can claim, then you can do a whole bunch of planning as an example. Yeah. Let's say New South Wales land tax it only applies on 31st of December on the settlement date. Yeah. If I own that property in New South Wales on 31st of December, if I'm over the threshold, I pay the land tax. So if you're sort of considering of selling it between now till say December, now it's about June, July, August, then you sort of say, well, I would prefer to sell it before December as opposed to after December. So I'm going to be saving 1 year of land tax. Then you may say that, well, there is staying on the timing difference is that do I sell it in May or do I sell it in July? And if I sell it in July, then it could be 1 year later that I got to pay some of those tax. Then you sort of say that, well, when we say keeping the substantiation is that there could be a whole lot of expense that we could not claim it in day one. As an example, a buyer's agency fee that you pay buyer's agency fee must come on, right? Buyer's agency fee that you pay in day one, you sort of can't claim it because it's a capital cost. But when you're selling this buyer's agency cost could quite easily be added away as part of your cost base in reducing your capital gain tax, right? So there's many expenses of those that one can claim. So there is a timing adjustments and timing planning. And there is also that sort of a substantiation and strategic planning, which definitely can make an impact.
Yeah, so keeping every record is actually the key there.
Absolutely, wholeheartedly.
Now, Munzurul, we were in a federal election year.
Yes.
Have taxes changed due to the election?
God, it was the battle of the lever and the liberal. And then we sort of look back and we say that, all right, let's not make any political comments, right? And we don't, right? And both government tried to win back the first-time buyers as such quite strongly of sort of giving their own layer of the invitation and the incentive, so to speak, which is, in theory, all sounds good, right? Challenge what we see with this is that who is actually getting helped behind it. So is it really the first-time buyers, or because the first-time buyers can purchase a bit more, does that mean that the existing investors are sort of increasing the prices? So whenever you sort of look into an equation in the economics, right, and you look into the supply and the demand, and you sort of try to manage that sort of a demand level, that sort of becomes a bit harder, right? The question is, how do we work on the supply side of it? And I don't think that there was a lot more view on the supply side of it. It was more demand, that how do we sort of subdue the demand, i.e. that one shape or form create that availability, affordability to create that demand. So I worry that with all of those mechanism that the government has done is that whether it's going to help out the existing investors as opposed to the first-time investors and first-time buyers. Second comment which I say is that, of course, we are on a declining interest rate market at the moment, right? Yeah. Yes, we had a couple of drops and perhaps we are expecting a bit more, means that the market will naturally do much better. So what did I see? I saw some enormous amount of incentive being created by the government as well as the general economy, which is creating. And I think over the next few years, the property market would be very demandable.
It's going to be very high and very hot,
Yes.
and it's already happening. You can see a lot more people wanting to go. I think the declining interest rate, they've just given the last push for the people that were ready, financially ready, to just go and jump, either it is for the first time into the market or just buy that next investment property. Now, we know that the market is going to change. So how can investor plan for potential changes in tax law or into their investment strategy?
Yeah, look, the good question, right? I always sort of say as an investor, you got to look into a longer term. And while you are aware of some of the tax changes, one also knows that changes can be changed again. And sort of very often the changes are grandfather provision, i.e. is that it applies from now on. It doesn't apply too much. I'm a big fan of saying that things that we cannot control, we stay aware of it and we stay, I suppose, knowledge to it. But do we need to too, I suppose, conscious. Because it is sort of how it is, and irrespective of as much as we are, we've got no sort of control in terms of changing, but we stay aware of it, right? So I think, yes, you look into your tax laws, but you don't overdo it. So as an example, there was a period of time that Victoria government, with all the layer of the wisdom, came in saying that Queensland government, my apology, with all the layer of the wisdom is sort of say, we're going to imply this stamp duty, this land tax, this. Now, it was a discussion. And as soon as I came in on the parliament as a discussion, I had hundreds of my investors, I'm selling this because Queensland will pay so much and all the rest of it. And I was like, guys, look into the longer period of time. First of all, that hasn't happened as yet under the law. It's a discussion. Let's even assume, unfortunately, it does happen. Yes, you're right. If it does happen, the demand will drop. But then what it does is that this whole economy, as we call the invisible hand, the hand which sort of always at the end sort of balances out everything. Murphy's law of average. It balances out everything over a period of time. So in the longer period of time, it will all balance out. So I had a couple of investors coming in. I've sold everything in Queensland. And they said, did you sell it? I was like, no. And they were like, why not? Why not? Because with all those tax, I was like, I'm looking into the longer period of time. We look back to the history and we say none of those changes actually happened. But let's say even if they were to happen, I would still consider my decision was probably a lot more measured. And the reason I say measured is that I was looking at the longer period of time. So you stay aware of it, but without being overdoing it. So $3 million, the government sort of superannuation and charging extra is quite a bit on consideration at the moment. Everywhere I go, everyone asks, what happens after this? And the reality of it is that it's getting legislative as such, right? But again, we stay aware of it, but do we need to be too conscious? Because, the government changes and the rule changes.
So stay educated, stay informed, but don't take hasty decisions, basically, yeah?
Yeah, and the long term, exactly. And make the decision with the longer term view as opposed to just immediately what we see in front of us.
Fantastic. Well, Munzurul, thank you so much for your time today.
Okay.
This is all we have time for these episodes, but great, insightful conversation.
Thank you very much. Thank you, Emilie. Thank you for having me. Thank you.
No worries. Well, that was the Smart Property Investment Show. And we'll be back next week for another episode. Bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.